Welcome to the Explainer. Today we are unpacking something absolutely fascinating. We're diving into Fabio de Jesus Suarez Agadello's deeply revealing econometric analysis of the Hang Seng Index. Now, if you've been watching global markets lately, you already know the Hong Kong market has been this massive focal point of discussion, confusion, and, well, opportunity. Agadella's study actually cuts right through all that noise. It uses hard statistical data and institutional macroeconomic analysis to show us exactly what's happening beneath the surface. Okay, let's dive into this. To get the most out of this analysis, we're going to follow a clear diagnostic roadmap. First, we'll look at the symptoms of a downward trend. Second, a radical shift in index composition. Third, the 4 pillars of underperformance. Fourth, the anatomy of a market rally. And finally, a profound economic restructuring. Right, let's kick things off with part 1, symptoms of a downward trend. So here's the central paradox we really need to address. When you look at the Hang Seng over the last few years, you see these prolonged periods of just agonizing decline, right? But then they're suddenly punctuated by these extremely sharp vertical peaks. It totally begs the question, are we just looking at a cyclical bearish phase that's going to eventually self-correct? Or are we witnessing a permanent structural reality? Well, to answer that, Agudelo ran the numbers. The first major econometric finding from his study uses something called polynomial adjustments. Now, translating that math into plain English for us, the data confirms that the long-term trajectory is unequivocally downward. The model shows a clear peak in the medium term, which is basically a temporary rebound, followed immediately by a sustained downward slope. What this tells us is that those big advances we see on the charts, they're tactical, oversold rallies, they're short-lived bursts, absolutely not the beginning of a long-term structural comeback. And to further prove this, the study looks at distribution metrics, like the Gaussian curve and skewness. Basically, the math confirms a severe asymmetry in returns. In a normal, healthy, growing market, your distribution curve leans toward long-term growth. But here, the returns are heavily skewed toward stagnation and decline. The mathematical reality is that the bad days and the flat days are the norm, and those explosive good days are just statistical outliers. So if the math is screaming that the decline is structural, we really need to figure out why. Which brings us to part 2, a radical shift in index composition. Now, what's really interesting here is the complete transformation of the Hang Seng's DNA over the last 2 decades. It used to rely heavily on local Hong Kong legacy financials and real estate, but today, mainland China companies, including those mainland entities traded in Hong Kong known as H-shares and red chips, alongside the massive tech giants, they now account for a staggering 75 to 80% of the index's weight. The Hang Seng is now inextricably linked to the Chinese mainland economy. So let's look at the fallout of that in part 3, the 4 pillars of underperformance. Because the index is tied so tightly to the mainland economy now, it is highly vulnerable to mainland macroeconomic shocks. Agudelo's institutional analysis pinpoints 4 distinct compounding pressures that act as the pillars of the Hang Seng's underperformance. We're looking at a real estate crisis, intense regulatory pressure on the tech sector, deep macroeconomic deflationary trends, and a geopolitical environment focused on decoupling. Let's break these down one by one. First up is the real estate crisis. Keep in mind, large real estate developers and their associated financial institutions hold a huge amount of weight in the index. In 2020 and 2021, Beijing implemented the 3 red lines policy. This was a structural policy aimed at deleveraging a heavily indebted sector, but the direct market result? A massive liquidity crisis. It triggered historic debt defaults for giants like Evergrande and Country Garden and caused home sales to plummet. This instantly placed a really heavy downward anchor on the Hang Seng. The second pillar involves the tech sector, which makes up the most heavily weighted components of the modern Hang Seng. We're talking companies like Tencent, Alibaba, Meituan, and Xiaomi. Starting in 2020, we see a timeline of intensifying government regulations. In 2021, the focus was antitrust and data privacy. By 2022, regulations expanded into private education and video game restrictions. The culmination of all this by 2023 was a very sharp contraction in the valuations and market multiples of these tech behemoths, which literally pulled the whole index down with them. The third pillar is the broader macroeconomic environment. Post-pandemic, China's economic recovery has just been slower than global markets anticipated. We're seeing weak domestic consumption and low household confidence. And this has resulted in deflationary pressures on both the producer price index and the consumer price index. When you pair that deflation with a GDP growth rate sitting well below the historical double-digit averages we saw in previous decades, you get an economic environment that really suppresses broad market growth. And the fourth, final pillar is geopolitical. Trade and technology frictions between the US and China, along with specific investment restrictions, have fundamentally altered global capital flows. Institutional investors and pension funds in the US and Europe are drastically reducing their exposure to assets in China and Hong Kong. And that capital isn't just sitting in cash. It is actively migrating to alternative markets like the US, Japan, and India. This systemic reallocation of capital, which people often call decoupling or de-risking, steadily drains liquidity right out of the Hang Seng. Let's move to part 4 and see how this builds. We're going to look at the anatomy of a market rally. So if these 4 massive pillars are dragging the market down, why do we still see those explosive vertical jumps? Well, Agudalo's econometric data breaks down the exact mechanical cycle of these medium-term rallies. They're not random. They follow a highly predictable 3-step sequence. Step 1, valuations bottom out to historic extremes. Step 2, government or central bank authorities announce targeted stimuli. And step 3, a massive wave of short covering acts as absolute rocket fuel for stock prices. Let's look a little closer at how each step works. Step 1 is driven by a concept called mean reversion. Because the macro pressures we just talked about are so heavy, the index frequently falls to extreme levels of undervaluation, hitting historically low price-to-earnings or price-to-book ratios. When assets get that cheap, value investors and algorithmic traders step in specifically hunting for those bargains. This triggers a massive wave of oversold buying. It's like a rubber band stretched way too far down. It naturally just wants to snap back to its historical average. Step 2 is the catalyst. That stretched rubber band needs a trigger to actually release it, right? That usually comes as targeted monetary and political stimuli. Whenever the People's Bank of China or the State Council announces stimulus packages, like cutting reserve requirements for banks or injecting direct liquidity into the system, the market reacts instantly. These support measures provide the immediate cash and confidence needed to ignite a rally. And this brilliantly illustrates the third and most explosive step, the short squeeze. Because the long-term trend of the Hang Seng is downward, there's always a very high volume of short positions. Basically, investors betting the market will keep falling. But when step 2 happens and positive news hits, those short sellers are suddenly trapped. To cut their losses, they are forced to rapidly buy back shares. This panic buying creates a short-lived but incredibly intense upward impulse. This mechanical squeeze is exactly why the peaks in Agudalo's polynomial analysis look so sharp and vertical, rather than smooth and sustained. Which brings us to our final section, part 5, a profound economic restructuring. We've looked at the economic symptoms, the shift in composition, the macroeconomic pillars, and the anatomy of those tactical rallies. So the crucial point is captured perfectly in this definitive conclusion from Agudalo's study. The HSI's long-term underperformance is not due to a statistical anomaly, but rather to a profound restructuring of the Chinese economic model, sectoral regulations, and the geopolitical risk premium. This is the key takeaway, guys. What we are seeing on the charts is the mathematical footprint of an economy in deep structural transition. The medium-term growth we occasionally see, it merely captures cyclical rebounds driven by compressed valuations and liquidity injections. It is not a return to the old normal. Which leaves us with this really compelling question to ponder. If we know mathematically that the sudden bursts of growth are just cyclical bounces within a larger structural restructuring, how will global investors price this evolving geopolitical risk premium into the Hang Seng's future? Will capital just continue to reallocate, or will new valuations eventually match this new reality? It is going to be a fascinating dynamic to watch unfold. Thank you so much for joining me for this explainer, and as always, keep questioning the data.